Thanks very much, Nishith. We've been here a couple of times before and been broadcast. I think there were a couple of people at 2 in the morning in our firm before that sort of stayed up and watched and saw some replays.
Yeah.
Thanks to the STEP boards. Appreciate opportunity. I used to be chair of the Silicon Valley STEP, and Peter's on the board of directors. So if you're coming to San Francisco, and give us an advance note, and maybe we can set up a STEP meeting. What we have now is a kind of international overview targeting really US to India, India to US. This is a very major part of our practice. In fact, we are now the India desk for our firm, which
very nice.
So for 25 years, we had a firm that was very international with in Silicon Valley, maybe 60% of the CEOs and founders are foreign-born. A big number are from Asia, Europe. So we're constantly looking at structures, pre-arrival planning, exit planning, use of U.S. and foreign trust. So what we'll do is go through our PowerPoint in no more than an hour, and then it's a small group. So feel free to ask questions, and we'll try to get through all the material. Peter, I'll introduce Peter, is a trust and estates planning lawyer before he joined our prior firm. For 8 years, he was in a law practice, and that was his target area. He joined Robotham International, and then for another 11 years, was practicing, but all of a sudden it grew internationally, and so his clients are worldwide. He has the largest India-U.S. practice in our whole office at Crow LLP, and probably one of the few offices throughout the U.S. that does as much as we do in this whole area of succession planning. We get involved in a lot of corporate transactions. I'm a little bit more of a corporate person, but dealing with a lot of high net worth individuals. I started with PwC years ago in their London office, and then formed a firm in '91, and that went for 25 years, and we kind of outgrew our ability to. We're seeing a lot of corporate acquisitions and other transactions, so we needed a bigger platform. We are running the global private client practice group on the West Coast. We have ourselves and the New York office are the largest practice centers. But for today, it's just all about U.S. and India. So we're pleased to be here. And we'll start right in. And please ask any questions you like. And we'll try to make this as examples. We're in Mumbai for the week, leaving about midnight Friday. So we have quite a few meetings with these situations. So we're constantly dealing with what is a resident in the U.S. And it is similar in some ways to Indian tax residency. If you're here for a period of time, if you're in the U.S. for a period of time, you're a resident. That's not a good outcome for many individuals or families from India. Become subject to worldwide taxation. And in addition to worldwide tax, so stock sale through the Indian exchange is tax exempt. Well, if the person is here as a U.S. citizen or they're a green card resident, they still have to report and pay tax in the U.S. on that transaction. So there's a lot of surprises for people from India when they come to the U.S. The domestic law basically has a couple of tests for worldwide taxation. There's something called a substantial presence formula, and it's a 3-year test. If it exceeds 182 days, then there's worldwide taxation, you become a resident. Unless there's a more presence, more business, more family activities, so one can get an exception to this formula. But the exceptions don't apply if in the year of testing you're in the U.S. for more than 182 days. The only way to avoid U.S. taxation on worldwide assets is if you're a green card holder and you happen to be living outside the U.S. in a treaty country. So let's say someone's gone to the U.S., they've obtained their green card, they are defined as a resident. It's basic domestic statute. But if they're back in India and their family business operations are here, there are treaty tiebreaker tests. And essentially, if there's a home in both locations. If it's a home only in India and the person's staying in a hotel in the U.S., there's no permanent home in the U.S. And with Indian citizenship and a presence in India, they're allowed to actually file a non-resident return. And that shocks a lot of people. There's a lot of bad advice about this particular rule. So I'll say it again. An individual that has a green card that has more attributes in India in terms of family, social connections. They may have a residence in both places, but if their family, social connections are mostly in India and they have Indian citizenship, they can be a non-resident for calculating their tax. And the outcome of that is all Indian source, all foreign or non-U.S. source income is exempt. So that startles a lot of people that they can hold a green card and exclude tax. But you have to be in a treaty country. It doesn't work if you go to Singapore or Hong Kong, no treaty. So this is a big planning opportunity we use for many of our clients.
Just to add one thing and ask you about it, that first, as far as the green card holders are concerned, it is under the tie-breaking rule that is included in the tax treaty. So that
Article 4,
if you happen to be resident of both the countries, this is the situation he's dealing with. Because many a times what happens, because of either the presence in the US, you become resident, or green card holder, you become resident, but you are also a resident of India, because the way in which you calculate a number of days or otherwise, you could also be a resident of India. And in that case, the treaty provides something called a tie-breaking rule. It means if you are a resident of both the countries, then in which country you will be regarded as resident of. And in that event, one would look at what are personal economic connections, where are they closer. Okay, so then you can say, okay, I'm not a resident of the US because my personal economic connections are closer to India. And as you mentioned, that US taxes the residents on the worldwide income, and as far as India is concerned, they also tax on worldwide income, but tax rates in the US are higher than India in general. Okay, our tax rates go to about 33%. I think yours tax rates are about 40%.
Well, it depends where you live. If you live in California, the federal top rates are 37, but California has a 13 and a third. So you can get up to 50% federal and state on ordinary income.
I know a house in New York, and
New York's
there are 3 levels of taxation. Federal income tax, which is 37% now. How much is
federal's top rate?
Top rate is 37%. Then there is a state level tax, as you said, in California it's about 13%. But I believe you get deduction for the state income tax, like business. And so effective tax rate would be about 45.
It was good, but thank you, Mr. Trump. So let's say you're in California and you're a successful lawyer accountant and earning over 200,000 or whatever number. You're right. Up to the end of 2017, there was a full deduction for state tax, so it would result in a discount of the effective state rate. But the new tax law, as of December 2017, limits state tax deduction to $10,000. And with anybody earning substantial income in New York or California,
he doesn't like California.
Well, California and New York tried to sue and change, and then California even sort of made noises about we're going to treat it as a charitable contribution, but it's not flying. So we've lost our state tax deduction.
Right. So just tell me, if somebody's in New York, if you have any idea about it. What kind of tax will happen? Because there is a federal level income tax, 37%, plus a state level, which is now on the top of federal level without getting any deduction excess of 10,000.
Right.
So, about how much is the tax rate in New York?
Well, you're going to
Yes,
get, let's say you're a stockbroker or you're a successful attorney. After you go through the lower rates, you're going to be paying 37%.
Yeah.
And you'll be paying 12 plus percent New York, which
New York State.
New York State. So if you're making $1 million, that could be 100,000 plus.
And on the top of it,
But
New York City level,
there's some city tax as well.
Income tax.
But all you can claim as a deduction is 10,000.
Yeah. So effective tax rate, say in a place like New York, if you're a resident of New York,
it's 50%.
it's over 50%.
Yeah, with state and city.
Because now you don't get deduction for state level tax. So does it mean that it could be as high as 24%? On the New York income. But
well, the New York would be the, say, 12% around the top and another percent or two for city. So you might be 13 plus so 20, on top of 37.
Almost 26% more.
No, it'd be like about 13 on top of the 37% ordinary. So you're hitting 50% because of state. Unless you live in Arizona or Nevada or Washington State where they have zero
taxes,
low
Florida,
tax.
something like that. So we are discussing dual taxation that happens because you may be tax resident of India and the US, and how can you break the tie and stuff like that. But the effective tax rate today in the US on individuals is 37%. On the top of it, in places like California, there is another 13% tax. Until recently, that 13% tax was more like a business deduction, So your 13% would be deductible from your income. So let's say another 40% of 13%, about 4%, so about 45%. But in city like New York, there is even city level income tax. So there is a federal income tax, 37%. Then on the top of it, you have about 12% is New York state level, and New York City level income tax also exists. So it is another 12% or so. So effectively, we are talking about 50% tax in a place like New York. Now, first thing, if you are a citizen of US, you are trapped anyway. But number two, if you are a green card holder, because of that you are treated as resident of the US, or if you are treated as a resident because of a substantial presence, even if you do not have a green card. Some of you already know this situation. Now, therefore, one interesting situation that we constantly come across is that you may be tax resident of India in the same year as you are resident of the US. Because suppose you're a green card holder, even one day holding green card, you are resident of the US. So you're resident there. But your substantial presence has been in India. Okay. Therefore, you're Indian resident as well. Now what happens? You're taxed both ways on a global income. So it's a disaster. So tax treaty provides for something called tie breaking rule. When you're resident of both the countries, you can break the tie in favor of the country where your personal and economic connections are closer. Okay, number one. So you can say my personal economic connections are closer to India. Why do you want India? Because Indian tax rates are lower, 33%, and there is no further state level. So significant, I believe the same rule will apply for state level as well, tie breaking rule, or because there is another twinkle to that, because
California
it applies only.
California, the states have different rules, so we're mostly talking about.
But if you are a non-resident Californian, otherwise, you'll be taxed only on the local California income, but you may not be taxed on the whole thing. So, most important thing is to know that there is tie-breaking rule, and you can break the tie in favor of India. One of the major advantages perhaps you can take. See, in India, if you are a foreign person or non-resident, if you sell shares of an Indian company, okay, then still India taxes non-residents on capital gains. Correct? Foreign person selling shares gain. In the US, it's exactly otherwise. Code section 865, it is worded in a way that if you are a non-resident alien, non-resident foreign citizen, then even if you make $1 billion gain from the sale of US company shares, you are not taxed. This is a major advantage for becoming a non-resident. So this is the upside. So you may often want to remain, even if you have a green card or otherwise your personal economic connections in India, maybe you can say that, okay, I'm a non-resident and therefore I'm not liable to pay capital gains tax in the US. And number two, the other thing that we'll have to bear in mind and we'll discuss separately is what happens to the estate tax if you're holding shares, which I'm not going to deal with right now, but
Peter will talk
come
about
up.
it. It'll come up.
only one small caveat here. This tie-breaking rule does not necessarily apply to the citizens
Right, it does not.
of the US.
Correct.
So it is available only if you are resident of the US because of your substantial presence, or if you are a resident of the US because of your green card.
Yep.
And then you are also a resident of India, then this benefit is available. But if you are a US citizen, then the tie-breaking rule doesn't apply.
Right.
And
So here's an example. This morning we were talking to an individual who's got a green card, and his family is selling their company, a listed company. They're going to basically sell a large block. I guess they're in a promoter category. Anyway, he lives here. He has a green card. The amount of the sale is very substantial. Zero tax in the U.S. He has to file a return as a non-resident, and there's some disclosures I'll get to. But once again, the treaty says tiebreaker, the person is more resident in India with citizenship. The calculation or the tax is only on U.S. source income. He's here, the stock is here, zero tax. And that comes up frequently, so don't be deterred by the green card status. Another case we were working on is an individual, again, green card. Everybody went to America, got their green cards, and decided I'm coming back to India. So this individual has a lot of business in Dubai, and they want to change their status from an Indian currency or FEMA resident. They want to cut that status under the currency regs. And so we advised that's a currency, but you have to be if you have to be resident in India and the U.S. to use the treaty. So when you break your currency status for residency, make sure you still retain your Indian tax residency. Then you can use the treaty, and then the individual can basically sell any assets they wish in India without U.S. repercussions. So you need to be resident in both countries to use this tiebreaker test.
I have a question, if I may. Would the tiebreaker test apply even if an Indian citizen green card holder also meets the substantial presence test?
Yes. Yep. I mean, basically, somebody could be, again, we looked at this. If the person is a resident in both countries, there's 4 tests. The first test is, do they have a home? Are they renting or leasing in U.S. and do they have a home in India? If there's only the home in India, you're done. The person is resident in both countries, but the home is only in India, the permanent home. So right there you stop. You don't even go to the next test. The person's an Indian resident, even though they blew through and are 200 days in the U.S. If they're in hotels, or in one case we had a mother, she's over in the U.S. and she's just sleeping over at her children's home. Well, that's not a permanent home. So
the answer is yes, but there's a potential issue. So if you look at the treaty tiebreaker test, we're looking at facts and circumstances. Do you have a closer connection to India? And so if you're satisfied in the substantial presence test as well, that also means you're staying probably more than 200 days in the U.S., right? So more likely than not means you have a home in the U.S. too. So if you have a home in both places, and now you have to go down to the next level where your social ties. If you're spending over 200 days in the U.S., your social ties, your business ties, probably maybe in both places as well. So that's where it gets a little bit more difficult, right? So because it's, the treaty tiebreaker is all about looking at the facts, and if the facts show that you pass a substantial presence test, probably also you have a closer connection to the U.S. than you do to India, but not necessarily.
So if you're the CEO of the listed company in India and you're spending, let's say, 190 days in hotels all around the U.S. dealing with the affiliates and subsidiaries, but you're really connected to the headquarters company in India and you're hoteling it, you don't have a residence or a fixed home, a fixed apartment, that's a good fact pattern. You don't have a permanent residence in the U.S. and you stop there because you're dual resident and you get the Indian outcome. But as Peter says, if you're staying so long, we told our client, partly joking but truth, don't have your children build out an in-law suite because that could be a permanent residence. You know, give her a bedroom or something. And these are kind of quirky facts, but real test with an audit. So these things are these things are looked at in detail.
Question, if I may ask here, is that, see, in India, every taxpayer has standard single accounting year beginning on 1st of April
Mm-hmm.
to 31st of March, number one.
Mhm.
And in the US, I believe you can still choose
Right.
your accounting year for tax purposes. Am I right?
Correct. I mean, it's an initial year of filing.
Yeah.
There's a rule about, so we used to have a lot of Australians coming over, which they're at June 30 year end. So you need to keep your books and records
Mm-hmm.
on that year. So there's some business reason, but you are correct. In your initial year, you can choose. So that might help you cut off a 183-day rule in, say, the first year if you pick your year end.
So with your very first U.S. tax filing, if you elect a fiscal year, you'll be fine. But if your very first U.S. tax return is a calendar year, then you're stuck with that going
Then
forward.
you cannot change.
And you cannot change, or it's very difficult
Very
to
difficult.
change.
Acha.
Yeah.
One more question here, because there are fundamental issues, with people. If somebody, say, migrates in the month of October,
Mhm.
okay, so accounting year is a December, or even if you take March, whichever,
Mm-hmm.
um, can one be considered to be tax resident only for that half the year, or it can be, because in India,
Mhm.
it is the only test that is applied is number of days for which a person is physically present,
Mhm.
and the tax residency is attributable to entire year.
Mhm.
Okay,
Mm-hmm.
so April to March, and you say, let's say 183 days.
Mhm.
Okay, you done that, you are tax resident.
Yeah.
Period. Okay, just simple words.
Actually,
Uh,
I have a
but
slide. Next slide is
but
close to that.
in the
Go
US,
ahead.
what I would like to ask is that you cannot have a situation under tax laws that for half the year tax resident and half the year not. Okay, for
Mm-hmm.
FEMA purposes, you can have uh, a residency beginning from the day on which you leave India
Mhm.
for good or for some other whatever
Mhm.
qualitative factors are included in the definition.
Mhm.
So, what I would like to understand, and for the benefit of everybody here,
Mhm.
is that for half the year also one could be treated as for the pre green card holding
Mhm.
period,
Mhm.
or for that particular area he
Yeah.
would be
There's very detailed rules. So let's say I arrive in October and I'm only there for 3 months. So if I'm just with an Indian passport, I'm not there long enough to meet the formula, let's assume.
Mhm.
I'm not there for more than 182 days. So I am a non-resident, even though I'm there every day.
Yeah.
Now, there is some election if
Sure.
you're there for more than 7. You choose to be a resident. You can make an election, and why you would do that, it depends on very particular circumstances. If I arrived, got my green card in India, here it is, and then I fly over to the U.S. on December 1 with a green card, I become resident on that day. So there's not a counting or 182. Green card, the moment I touch foot in the U.S. with a green card, I'm a resident, 100% taxable on worldwide income. So it varies as to the start date of residency, depending on your circumstances.
So important point to bear in mind is that if you become tax resident of the US and you become also continue to remain tax resident of India, to do or get a tie breaking rule, you must file a tax return. And
Yes, right. You have to file a return in order to claim the benefit of the treaty.
The tie breaking rule.
And we have had a lot of people are living in India that have been in the U.S. that have green cards, and they've kind of let things slide. We can file a treaty-based return several years later, there isn't a denial of the treaty benefit for a late return. And
Right.
that can really help where people are trying to catch up prior taxes.
A couple of things I want to point about this slide. So there's basically three ways to be U.S. tax resident. One, you're a citizen and you have no exceptions out of being a tax resident if you're a U.S. citizen. The second way is if you're a green card holder, then you're a U.S. tax resident by default. But as we were discussing, you can rely upon a treaty to basically tie break to your home country, India or another country. So you do have an exception from residency if you get a green card. If you're only tax resident in the U.S. because of the substantial presence test, then you have additional options. You have the treaty, and you have something else here called a closer connection exception. So first of all, substantial presence is 183 days according to this formula. All the days in the current year, plus a third of the days in the prior year, plus a sixth of the days in the year prior to that. So you'll notice here that if you spend 120 days in the U.S. every year, you will never meet the substantial presence test. If you spend 121 days, then you will have met the substantial presence test. And so if you pass that, right, then you can rely upon a closer connection exception, not the treaty. Although it follows the same facts and circumstances analysis, you're not relying upon the treaty to get out of U.S. residency. And there's a particular importance to that. So if you're a green card and you're relying upon the treaty, you can calculate your taxes as if you're a non-resident. So therefore, you're only paying U.S. income taxes on U.S. source income. Anything earned outside the U.S. is not subject to U.S. taxes. But because you are a green card holder and therefore a default U.S. tax resident, you still have reporting requirements. So if you've got a bank account in the U.S., you still need to file your FBARs to report that. If you own foreign companies in India or anywhere else, you still need to report them. Okay, so even though you're not paying taxes in the U.S., you still have a reporting requirement. And if you don't you don't fulfill your obligations to make those reports, you've got a lot of penalties that you may be assessed.
So actually, we better move on so we can cover
Okay.
as much
So
of the
if you're
material.
clo-
Don't worry about time. I think
Okay.
this is very
Oh,
important
okay. Well, I was-
for the benefit.
So
It
this
will
is-
go on for a long time.
Well, okay, if you we're going to hit some slides on
Yeah.
that. So,
Sure.
what the purpose of this slide is to tell you before your Indian clients come to the U.S., they have to think hard pre-arrival planning. So, a lot of we're familiar with. There's a lot of Singapore structures, and so when people move into the U.S. and they're holding assets under a Singapore company, and they're living in the U.S. or coming to the U.S. Generally, a foreign corporation has a lot of disclosure requirements, and now there are new rules in the U.S. that, in this case, where you have a foreign person who's living in the U.S., let's say that Singapore company is generating ordinary income from operations. It used to be it was not taxed until a dividend was paid. They've got a whole new tax regime, and so the income down below under that foreign company is currently taxed in the U.S. And I can't go through all the solution. There aren't really solutions. It requires a lot of planning. The second problem with this structure is that, let's say a person moves into the U.S. and they have this structure where they're holding appreciated assets under the foreign company. When they move into the U.S., if they sell those assets in a foreign company, they lose the capital gain status. So in the U.S., the capital gain rates are 20%. So if you own Google stock or you own an interest, is Reliant a public company?
Mm-hmm.
Okay, so you got some Reliant stock, you move over to the U.S., and that's held by some foreign company. Now when you're in the U.S. and the company sells that stock, it comes through currently to the taxpayer at ordinary income tax rates. So you lose the benefit of the long-term capital gain rate. So typically we're advising people with existing foreign corporate structures, consider making an election that can technically, for U.S. tax, eliminate the foreign company or literally liquidate, get your assets out of a foreign company. It's not a good structure. The U.S. rules are basically designed to prevent you by imposing much bigger tax rates to prevent you from moving liquid assets into an offshore holding company. So if you enter the U.S. with this structure in place. You may be stuck with it with bad outcomes. Once you're in the U.S., you can't liquidate that company. You'll trigger the full tax anyway. So a big part is pre-arrival planning.
So before, when you go to the US and you park your foreign assets in a holding structure,
Mhm.
which is eligible for check the box election, can
Right.
one check the box before? I'm sorry. Before
Oh,
before.
they say someone's calling in to speak louder. Go 2 hours.
So the thing is that if somebody has the structure in abroad, and he can check the box before even entering the US, is it possible?
Well, okay. So we had a situation where somebody came over from Hong Kong and they had a BVI company which had some highly appreciated shares. He was a venture capitalist, moved to Palo Alto.
Mm-hmm.
So he was advised to make an election to effectively liquidate that BVI holdco, and that does two things. The stock is distributed up, and it triggers at no tax cost because the individual is still outside the U.S. It steps up the basis to the fair value. So when that individual, let's say, becomes resident in January, they already eliminated pre-arrival.
Yeah.
They eliminated that bad structure, and it's on the face of it, it's a good thing to do. We had to caution this client. We didn't advise him to check the box. He'd already done it when he came to us in January, and we said, well, when you were in a prior year, you had no connect with the U.S., so that election is not really relevant to your U.S. activities. You didn't arrive till January. So there's some rules about making elections and whether they are recognized. We would have told them make that election in January before you arrived, because clearly in the subsequent year, you're a resident, becoming a resident. Therefore, that election's respected. Making it in a year when there's no connect to anything in the U.S., there's some uncertainty that there's no relevance to U.S. and IRS could challenge it. But generally, that's a good thing to do. Generally, it's
So what they're referring to regarding the check the box is if you own a company that provides you limited liability, then for U.S. tax purposes, they will call that company a corporation and tax it accordingly. If you want to, you can make an election for U.S. tax purposes to treat that otherwise corporation as a pass-through entity, and there are certain benefits to doing so. It depends upon the situation.
Let's say you have
It's called a check the box election.
If you have an Indian LP,
Yes.
that's default. It's in the U.S. a corp.
Correct.
But maybe using this election, it gets you where you want it.
So one thing to be very careful about is the election is broadly available for most types of entities. But there are certain companies known as per se corporations for which you cannot make the election. And I think for India, they're public limiteds, right? Those are the ones that you cannot.
Yeah, publicly. See, just to some of you already know about this, is that in the US there is something called check the box election. It means that if you have an entity which is not a listed company, you can treat it as a partnership or what is called flow-through entity. In India, partnerships are not, for Indian taxpayers, not flow-through. So the entity is not taxed, only the partners or the beneficiaries are taxed. So before you leave the India, or even after leaving, you can check the box. If you are continuing to remain non-resident alien because of the tie-breaking rule, so one method is that before you go to the US, then you check the box. Indian tax doesn't, company remains company, everything as it is. But when you go to the US, it will be deemed that you are directly holding the underlying asset. Okay, so then that rule will not apply for a holding company and stuff like that. So there are rules which allows you to treat foreign company, if you are a US resident, a foreign company as a partnership or flow-through entity. but it is not available if you are a publicly listed company. If you are an unlisted company or otherwise, that would be possible. And in fact, I had written original rules for India on the US Treasury side for per se corporation, because some
Right.
entities are regarded per se they are corporation. Otherwise, so if, but it is not a per se corporation, you can check them out. That's what he.
Correct. And as far as the timing is concerned, you basically have 90 days. So, for example, let's say you arrive in the U.S. January 15. You still can make the election all the way back to January 1 if you want to, as long as it's within 90 days. Now, in theory, you can go even further than that, but you basically have to ask permission from the IRS in order to get to do that. So if you do it within 90 days, so that's an automatic. That's okay.
So let's look at the hazard of the green card person or U.S. citizen living in India. So on slide number 7, this is a list of forms that are mandated by the U.S. Law and regulations and penalties for non-filing. Just historically going back in 2009, the U.S. basically came across, or there was a whistleblower case with the UBS, and the Swiss bank was coming to the U.S., recruiting American investors to put their money in Switzerland, and so don't worry, we don't report to anybody. So the U.S. Penalized UBS, and then they instituted and revamped their whole penalty scheme and required substantial disclosure. So I won't go into detail with all the forms, but if you form a foreign trust or you get distributions from a foreign trust, you've got to deal with these forms, 3520 and 3520A. And the penalties can really rack up high as the millions of dollars of wealth stack up in these entities. Early on, Peter and I represented a lot of people, actually people from India, people that it seemed like people here liked UBS. It was a good place, Credit Suisse, HSBC. So the IRS basically went after the banks, forced the banks to turn over their depositors in Switzerland, the U.S. Investors, and pressured HSBC and a lot of the big institutions. So all these people came running into the IRS, and they got totally slammed with huge penalties for not disclosing their U.S. bank accounts, their investments in foreign companies. These rules continue on today, and if anything, they're as stringent. From 2009 to September last year, they had various programs. If you voluntarily came in, they would cut the penalties down. If they catch you, you're going to lose 50% of your financial accounts, plus these other penalties for specific forms. So if you have an investment over 10%, or you control a partnership, it's Form 8865, and it's $10,000 per year per entity. So I'm sure some of the clients you have that may have green cards or citizens, they have investments all over the place, 20 or 30, and pretty soon this starts to add up.
So what I understand is that when you become tax resident of the US, then you are supposed to be reporting your foreign holdings,
Correct.
either or your interest in foreign trusts.
Yeah.
And that is the first, because reporting is the first requirement. If you don't do that, then these are the penalties that
and on every audit, even the domestic audit, on the top of the forms the IRS uses are, do you have any foreign? They put this into their standard audit, even though you may be somebody in middle America. This has now become a standard part of the practice to ask questions, and you can't not tell them the right answer, or now you're into federal offenses with hiding.
India has learned the same thing, so we also have the same requirement for disclosures in our tax return if you have foreign accounts.
Your rules are worse. I think they're tougher. I mean, India will take away your future and your money.
But anyway, that is the important part to understand.
Yes.
Okay.
And we always get this question, well, is this going to start an audit? Absolutely not. We've had every type of disclosure, and I can honestly say, if you ask the IRS, they'll say no. The one thing people worry and say, well, is the IRS going to data mine the financial information if I have 10 or 15 bank accounts around They probably will for their own purposes to sort of figure out where people are holding money or maybe non-reporting issues. But will the filing of these forms attached to your return trigger an audit? The answer is I can't prove it, but my answer is no. What happens, people get into an audit, and then these questions come up, or their advisor is not too sophisticated and takes the client into the room with the IRS auditor, and they get asked questions, and they're right there, and they blurb it out. But these things themselves don't create tax audits. So we always advise our clients, just fill out the forms. Okay, you've got 20 accounts. You might miss that one account in Hong Kong for $100. Don't worry, it's there's a reasonableness in depending on the amounts and the circumstances. But do your best to get these forms filed. There's no downside other than it's time and sweat and a little bit of it's some professional fees if you don't want to do it yourself. Okay, now you're that Indian. You got your green card and you're fed up and you want to get rid of your green card and give it up, come back to India. You're going to quit and expatriate. So expatriation has been a big part of our international advisory practice. So if somebody is coming into a great amount of wealth, what I understand is happening in India right now is the demographics, this level of the family, the aging millionaire, billionaire, and so it may not necessarily be tax driven, but there's this huge amount of wealth that's going to be passed down in the next decade. So a lot of that is headed towards U.S. beneficiaries, and so there's a lot of concern about what happens if my family in the U.S. Inherits all this. Well, they have to pay all income tax, and then it's locked in their estate, in a U.S. estate. So people are looking at this and saying, I don't really need to live in the U.S. I can get my Indian citizenship. I'm going to give my U.S. Passport up. Or if I've had a green card for more than 7 out of the last 15 years. So if I'm in the U.S. for 5 years, I make $100 million, I tech company, and I bail and throw in my card, and I've only been in the U.S. 5 years. No problem. No exit tax. If I've been filing as a green card resident for more than 7 years, the U.S. is going to trigger a deemed sale on your worldwide wealth. And we've got real problems with a few of our clients. The Indian parents have passed down some wealth to their U.S. citizen children that were born in the U.S. And now they're 20, 30, and they're worth huge amounts because it's listed stock in India. And these individuals are partly here or intending to come back to India. And we can't get them through this without major planning, because ultimately, if you're over $2 million in wealth, or your past 5 years have had high income taxes paid, then your appreciation on your worldwide assets is triggered, even if your listed stock is over here in India. So I always tell people the U.S. tax regime is not fair, but it's there. Yeah. You're stuck with it. Worldwide, even though the appreciation of the assets, family legacy, tough luck. It's your asset, and it's it's the U.S. tax system, and it just defines the asset as well. You own it. It doesn't matter if it's foreign. So we employ various strategies to minimize this. And an easy strategy would be the following. So let's say I am that person. My parents in India gave me a lot of stock, old company, zero basis, and then now it's worth $20 million. And I want to move back to India, and what do? There's no basis. It's worth $20 million. We'll get into this a little bit more with gift tax, estate tax, but a U.S. citizen can give away now $11 million without any gift tax. So maybe that person would think about giving up of their 20, they're going to give up 11 back to the family in India. They can do that because they're a citizen. Now they're down to 9 million. So when they give up their citizenship, they're going to face a tax on the appreciation of that 9 million. So we haven't solved the problem; we've minimized it. And this is a constant surprise. I mean, Peter deals with this a lot with how to form structures to reduce the tax on wealth by citizens wanting to give up their status. And yeah, but,
And one thing to consider about long-term residency, we're talking about those with a green card who hold a green card for more than 7 years. We don't count the 7 years, 365 days. Instead, we count any year in which they have a green card. So, for example, let's say they have a green card issued to them on December 31st, 2019. That's 1 year. So, come January 1, 2020, they now have a green card for 2 years. Okay. So that's the way we would calculate have they had a green card for more than 7 years.
So I think in summary, what you say is that if somebody holds green card or is a U.S. tax resident for a period of 7 years, and I believe out of 15 years, right?
More than 7 years, yeah. So 8 out of 15.
So,
yeah.
8 out of 15 years. Then if you give up your residency, you are deemed to have disposed of your global assets, and you have to pay equivalent to capital gains tax
Correct.
in the US,
Right.
which
It's
is
a deemed
20%.
sale of all your assets, and then you pay 20%
Right.
on the
It will
gain.
be a 20% tax.
Correct.
yeah.
Or-
Well, if I have, I'm with a company and I have stock options
Yeah.
that are in the money. I got an exercise price of $2 and it's worth 50. That's probably ordinary income. So a deemed sale in that instance could
it will
trigger
become
ordinary income taxes.
So that
whatever
could
the
be
tax rate.
37 plus 12,
Correct.
whatever it is.
Yeah.
Yeah.
So it's.
In California, is there a distinction in tax rate on capital gains and ordinary income? It's same, I believe, right?
Correct.
More or less.
Used to be short, mid, long term, but they just said we'll tax it all as ordinary. There's no differentiation.
So capital gains are also taxed at the rate of
Yeah.
12%.
I mean, people talk. California and New York have figured out they could put 15% tax rates. People are going to go to those jurisdictions because there's the money, there's the expertise, there's the ability to scale up a business. Why people leave California or New York is the cost of doing business. Employees and rent and just taxes. But we don't see entrepreneurs fleeing California until they're kind of on the verge of selling their company, and they are going to leave California anyway. But California isn't really suffering from entrepreneurial opportunities in businesses because of tax rates. People complain about it, but it's still a place where you go to ramp up your company as fast as anywhere in the U.S. and you have resources.
And second point I understand from you is that there is estate tax in which there is 11.7 million
11.4 million.
is a tax exempt limit,
Mhm.
and that applies equally to citizens, green card holders in substantial presence also.
Not quite. No, we'll talk about it a little bit
Actually,
more
you'll
later.
talk about it,
Yes,
yeah.
Yes.
Because earlier non-citizens had different thresholds.
Correct.
And
Question?
Is there a difference between a temporary green card holder, because there are a lot of people applying for green card who are already staying in US.
Mhm.
So is there a difference between people who are already staying there, paying the tax over there, and then applying for green card, and they are going to take 7 years to get their green card back?
Okay, so when people immigrate to the U.S., they can come on an H-1B, which is a work visa, or they might come on a different, like an E-2, which is another work visa. So in those cases, they become resident. They haven't got the green card, but as soon as they hit the formula or the count, they become resident. Similar to India, if you stay here 2 years or 706, despite your visa. So your visa may say temporary, but if your days exceed 182, the tax law, not the visa rules, the tax law says you're a resident. And they have these temporary green cards, but a green card's a green card for tax. Meaning,
this regime is not going to apply if there is a temporary green card.
Well, the expatriate. Okay, so the question is, if you have a green card, when do you start counting? I don't see any distinction as to green card differentiation. So a temporary. I mean, these are distinctions in immigration law, but tax law doesn't always. Tax law is totally separate, and the terms get confusing. So a green card is a green card.
Right. So you don't count the visa days, but you start counting the green card days.
In fact, I've been going to the US since 1981. But one thing I decided day one, because I'm a tax lawyer,
Yeah.
that I would not take green card. I would not
Right.
become substantial presence
Yeah.
person. And of course, citizenship out of question.
Right.
Mhm.
But L1 visa is very helpful.
Yes. Yes.
So compared to many other visa, if you want to do business in the US and want to confine your taxation only to the US, by and large, L1 visa we have found to be more
Mhm.
beneficial. Of course, there is nothing absolute in this
Right.
world, but just for your information,
Right. I mean, the visa will come up a few minutes. Peter talks
Oh.
about what's your domicile, and visa does have an
Yeah.
implication. But in the income tax rule, you've got the counting, you've got green card status, and then you have the treaty that can change the outcome. But there isn't a distinction on temporary.
Yeah.
I'll try to dispel a big myth that exists between the immigration profession and the tax profession. And it goes as follows. You're living in India and you're holding your green card and you're filing as a non-resident because the tiebreaker tests in the treaty say that that's permissible. And so then the immigration lawyer says you can't hold your green card while you're filing a non-resident return, even though that's okay in the tax area. And we frequently do battles with the immigration lawyers over this point. We have a tax opinion from, actually it's a legal opinion. The immigration regulations basically say if you hold a green card and then you choose going back to your country or a treaty country and you choose to file a non-resident return, there's a presumption that you're no longer living in the U.S. Because of filing that tax return. So we don't think you should you're entitled to the green card. But the reality is, it's just a bad fact. So we have a number of individuals, they have family in the U.S., they have property investments in the U.S. They are back here in the U.S., in India, filing the green card. They're filing non-resident returns, and taxes are fine. What happens is on the immigration side, these tax rules do not come up. What happens is a person goes back to the U.S. once a year and they start getting pushback by immigration. And they say, well, you haven't been here for 12 months and you only stayed 10 days. Why are you holding a green card? And so the immigration folks get concerned and sometimes upset when they see a lot of foreign nationals coming into the U.S. with their green cards, but they're really not living in the U.S., and that goes counter to the intent of issuing a green card. So people are constantly asking, what happens when I come into the U.S.? And I'm living in India, and the answer is, it depends on your facts. If you've got really bad facts and you have no connects in the U.S. and you're just coming through once a year, you're exposed to being challenged and having your green card taken away. And then you get to appeal that if you wish. And that's where all these questions come up. And how did you file your returns? Oh, non-residents? That's a bad fact. But in the day-to-day things, you're coming and going. The immigration folks don't even think about tax filings. They're just looking at your ins and outs, and they'll question you pretty hard. And if you give a lot of wrong answers, you'll end up in a side room, and they may take your green card, and then you have to call an attorney to sort of appeal it. So just keep that in mind. You can't have a green card, and you can't file non-resident returns. What the pressure point is, the immigration processor can drill you with any questions they want, and they can be pretty tough and take your card.
Right. The issue generally comes up when you file a non-resident return and then you go to apply for citizenship. Then it becomes a pretty big factor. You want to apply for U.S. citizenship, but you've been filing a non-resident return for the past 10 years. That's a bad fact towards your citizen application. It's not that you can't overcome it, but it's something that immigration attorneys really don't like. The other issue is if you apply for a re-entry permit, same thing. It's more difficult to get your re-entry permit if you've been filing a non-resident return. But otherwise, your green card should be pretty safe, even though you're filing a non-resident return.
So there's a few other strategies for minimizing your exit tax. I think maybe if we have time, we'll come back onto some of these more detail. I mean, we'll try to take assets and put them into a structure and discount the value of your slice using various valuation techniques. Then there's less tax, but it doesn't eliminate the tax. There are trust structures here we'll talk about. But there's no simple silver bullet solution to the laws. The tax reform passed in December. They didn't touch this. Nobody's really advocating for loosening up the expatriation rules. The U.S. view as well. You made 10 million or 100 million in the U.S. We want to take our chunk of that. When you leave, we don't care. You know, it's our last chance to tax you. So there's not a lot going on that's going to eliminate or reduce this, other than some strategies. But the law is going to be pretty static. Peter's going to take it forward on probably pretty hot areas, trusts and gifts, and there's a lot of activity in India using various trust structures. He'll take it from here on 10 or 15 pages worth. Go ahead.
So as Nisha was alluding to earlier, when we talking about U.S. residency, for income tax purposes, we have one test. For estate and gift tax purposes, we have a different test. So for income tax purposes, we covered a citizen, green card holder, or substantial presence. Any of those three, you are a U.S. income tax resident. For estate and gift tax purposes, you're a citizen, yes. Then you're a resident for estate and gift tax purposes. But we don't have a substantial presence test for estate and gift tax purposes. Green card, not enough. For estate and gift tax purposes, to be a U.S. resident, you're either a citizen or you have what's known as shifted your domicile from India or any other foreign country to the U.S. So what's shifting domicile look like?
It's just domicile. You have that concept in India as far as so it's a lot of different facts. It's not one statutory
let
rule.
me just tell you, we had estate tax until 86.
Okay.
And unfortunately, the cost of collection was higher than the actual collection, so it was decided to be rolled up.
All right.
And there was a criteria of domicile. So domicile in India, it was defined. There's no definition, but it was construed to mean that if you had a permanent intention to reside in that particular place, okay, so that is one. So you must have ultimate intention to reside there. And when I do comparative law studies in the US and several states, and I find that they say that if you do not have an immediate intention to move from that place, you're a domicile. It makes a big difference. So, for example, in one case, there was a UK citizen resident, and he was residing in the US, but UK, but he had written a letter to his family that my ultimate intention is to go back and die in India and buried in India, and I want to go back to India. Okay, 30 years. In the UK, it was held and that he was not domiciled of the UK.
Right.
So in the US, if you had the same situation, if you had no intention to immediately move from the US, you would be deemed domiciled.
Right.
So domicile is directly linked to intention at times.
Absolutely.
But the way in which different jurisdictions treat is also a little tricky to meet with those situations.
Right.
But you're right. So in India, for example, we don't have a estate tax. There's a lot of talk whether it will come back or not.
Right.
We have another situation come to us. But inheritance tax, most countries have this intention-based criteria than per se number of days criteria.
Correct. And the U.S. is the same. Basically, to shift your domicile, you need two things: intent to move to the U.S. and physically moving to the U.S. So how do they determine intent, though? It's really hard to get into someone's mind. But so they look at things like, where is your home? Where is your family? But they also look at public declarations. It can be oral testimony of what you've told your neighbors, what you've told to everybody else. But it could also be your documents, estate planning documents, for example, your will, in your will, you're declaring you are a resident of a particular state or county, and it could be the U.S. or it could be outside.
Now, if you come to the U.S. with your green card, you're toast because
More or less, yes, because
you guys made a declaration.
as part of getting your green card, you are making a public declaration that the U.S. is your permanent home. So is a green card enough then that the U.S. is your domicile? No, that's just one factor. It's a very strong factor, but only one factor. So if you've got your green card and you're living in the U.S., very likely the U.S. is now your domicile. But if you have a green card and you're living in India, probably not your domicile. India is probably still your domicile. Okay, so it's a very facts and circumstances analysis to determine what was your intent with regard to the U.S. And if it is the U.S., then now your domicile is the U.S., and so therefore you are subject to worldwide taxation, estate and gift taxation on your worldwide assets. But at the same time, if you are a resident of the state of the U.S. for estate and gift tax purposes, you're also granted an exemption, and currently that exemption is $11.4 million. Come January 1, 2026, the $11.4 million is scheduled to decrease to $6 million, but right now it's $11.4 million.
So, question: what is the tax rate currently on estate?
It would any assets over the exemption amount, it would be 40% estate taxes.
40%.
Okay.
And state level tax in California is
in California currently they have no estate or gift taxes.
Okay.
Correct. In Washington, it's actually pretty high. I think it's 10% in Washington State.
Oh, is it?
Yeah, they have no income
any
tax.
idea about New York?
I don't know.
Okay.
Yeah.
And as far as the exemption limit is concerned, is there any exemption in California? California.
Well, California, there is no estate tax.
Fortunately,
Yeah,
okay,
correct.
right,
Correct.
okay.
Okay. But
Just
yes.
to throw an example, if somebody from India comes to the U.S. and they come on an H-1B,
Yeah.
they come from a good family and they're worth a huge amount in their personal holdings in an Indian company, and there's a decision there's going to be a sale. So that H-1B person says, and they're going to do an exchange, so it's exempt in India. So that person that moved to the U.S. on H-1B says, "Oh, I think I'm going to give this stock away. I'm in the U.S. on H-1B, so I'm not domiciled, so I can give it away." Well, it
might be.
sounds okay, but if 5 years later that person's got family and they've got a house there, the IRS can say from the moment you touch foot, you seem to have that long-term intent. And remember that gift of stock to your family in India? We think that's fully subject to gift tax. So when intent can be proven out by later facts. So you have to be
this
very careful.
lifetime exemption is available to all the three categories: substantial presence, green card.
Well, again, substantial presence green card have nothing to do with residency for estate and gift tax purposes, right? So if it is shown that you have shifted your domicile to the U.S., then you get your exemption.
Oh, so no longer that there was some lower exemption for green card holders and others. That is no longer.
No.
60,000 and stuff like
that's
that.
No, that's for non-residents.
Only for non-residents.
Non-residents, correct. And so again, you have to be very careful when you're looking at the definition of resident. Are you talking about income taxes, or are you talking about estate and gift taxes?
Tax.
So that
if you're talking about estate-
mansion you have in New York, it's only a 60,000 exemption. So
because you're a non-resident, right?
I think we want to help America, so I also in Palo Alto. So
if you are a U.S. tax resident for estate and gift tax purposes, then when you make a transfer, either at death through your will or during life by a gift, then if it's $15,000 every year, no problem, no gift taxes, no tax filing. If it's above $15,000 in a given year, then you're using up some of your $11.4 million lifetime exemption. So if you give away $11.4 million during life, at death, if you still have more assets, then all of that will be subject to estate taxes upon your death if you're still a U.S. tax resident.
So exemption reduces if you make gifts.
Yes, correct. So if you give away $5 million during life, you'll have about $6 million left at death.
But the annual exclusion is for gift, $15,000.
$15,000.
So amounts in excess of that will count towards my lifetime exemption.
Correct. And the $15,000 is calculated per donee. So if you have 10 people you want to give $15,000 to, you can do that every year. Give $15,000 to 10 different friends, 20 different friends, doesn't matter. Okay, and you don't file a gift tax return, you don't pay any gift taxes. Yes.
You just said it's written over there scheduled to decrease to about 6 million in January. If
Yes.
somebody transfers, say, 10 million today,
Mhm.
so will he still have that 1 million limit left in 2026?
No, that's the thing. So basically, if you give away $11.4 million today, come January 1, 2026, your exemption is now zero. Okay, but you're looking on the bright side, you got to give away an extra $5 million before the law changed. Okay.
No, I was asking if he gives 10 million.
Yeah.
He still
Oh, no. Unfortunately,
1.4.
yes. No, that's a good question. Yes, if you only give away $6 million, let's say, right, come January 1, 2026, your exemption is now zero because you gave away your $6 million already.
So you do whatever you want to do now. Suppose you give $11 million, they are not going to tax you on that $5 million
Correct.
later on.
Correct.
Because $6 million exemption and
Right.
5.
But if you want to take advantage of that extra
You
$5
better do it
million,
now.
you have to do it now. You can't wait until later on. You lose it
But you'd still be subject to gift tax.
for future gifts. Yeah,
Okay.
correct.
See,
'Cause
whatever
because-
gift you make reduces your tax exemption from 11 million to 5. So there is no gift tax per se.
So the lifetime exemption is both
Is
for
reduced,
wealth,
yes.
estate, and gift tax.
Correct.
Correct.
Correct. Estate.
In fact, that was the reason why gift tax was abolished. I was part of the committee. I think VP Singh was the finance minister of that time. So first we eliminated estate tax, and then we said estate tax and gift taxes are usually integrated.
Correct.
Because you can always make away gift before passing away, right?
Right.
So, and also it did not make sense to have gift tax. So once estate tax went off, in the next year, gift tax was also removed. So we did not have any estate or gift tax until recently in a different form they have brought in. So if you make a gift to unrelated party, then that is considered to be income in the hands of the unrelated party. So, but immediate relatives are excluded, so that any amount of gift you can make.
But keep in mind, this is the giving away when people are in the U.S. More often, we're being asked if you're living in the U.S. And the parents in India wish to make gifts, particularly of Indian assets. There's pretty much no limit. There's no tax. Any amount can be gifted to the U.S. person. There's just a disclosure if it's over $100,000 from a single person. So we have lots of situations where the parents want to give $500,000 to their kids in the U.S. for down payment of a house. Actually, that's a lot for down payment, but in these days, so it's usually the Indian gifts coming over to the U.S. and we help with the disclosure, but that's a unlimited amount. Peter's talking about the giving away as a U.S. person.
Right. So if you're not a U.S. resident for estate and gift tax purposes, you are subject to U.S. estate and gift tax taxes only on U.S. cited assets. Okay, but your exemption is limited to only $60,000. So if you're a non-resident of the U.S., but you own a house in the U.S., for example, it's going to be worth well more than $60,000. At your death, then there's going to be estate taxes due at upwards of 40% on everything above $60,000 US. Okay. As a non-resident, you're also allowed to give away $15,000 every year during life. For U.S. persons, husband and wife, if you are a U.S. resident and you're giving to a U.S. citizen spouse, you can give an unlimited amount, no gift taxes whatsoever. You don't even use up any part of your $11.4 million exemption. But if your wife is not a U.S. citizen, she still may be a green card holder resident in the U.S. It doesn't matter. She's not a citizen. You're no longer allowed to give an unlimited amount. You're only allowed to give $155,000 this year anyway. It goes up a little bit every year.
To a U.S. citizen spouse, even beyond 11 million is all exempt?
Correct. Does it unlimited amount?
Unlimited
amount to a U.S. citizen spouse, no problem. But to a non-citizen spouse, even if they're resident in the U.S., you're limited at $155,000 a year. So this chart summarizes a little bit about what we're talking about here. For gift tax purposes, if you're a resident, then you can give away $15,000 every year to as many people as you like, no taxes. Or if you're above that, If you're above the $15,000, then you can eat into your lifetime exemption, $11.4 million currently. Anything above that is a 40% tax. If you are a non-resident making gifts, you still get your $15,000, just like a U.S. resident. But your lifetime exemption is now zero for gifts. And so any gifts you make of U.S. property is subject to 40% taxes.
In the hands of the donor.
In the hands of the donor, right? Estate and gift taxes are only applicable to the giver, the donor, not the recipient. The receipt of a gift for U.S. tax purposes, not taxable at all. It's reportable if it's received by a non-U.S. person, but is not taxable. Okay. For estate taxes, right? The tax rate is the same, 40%. And again, for residents, it's $11.4 million. For non-residents, we're only talking about $60,000. That's it, no more. But again, it's only applicable to U.S. property. Any non-U.S. property passes tax-free. Okay. So what is U.S.-sided property? It depends on what the asset we're talking about here. And it also depends upon which taxes we're talking about here. Very common is stocks. Stocks in U.S. companies. If you buy Apple stock, Microsoft stock, and you give it away during life, no problem, no gift taxes whatsoever, because it's an intangible asset. Doesn't matter how much it's worth, you can give it away as a non-resident of the U.S., not subject to gift taxes. Instead, though, if you die holding stock in Apple or Microsoft, then you will have estate taxes. So you need to be very, very careful in what you're investing in. So if you're investing in U.S. securities, you're usually best off having some intermediary vehicle, an Indian LLP, for example, that will hold the shares instead. So upon your death, you don't own shares in Apple or Microsoft. Instead, you own an interest in an Indian LLP. And so upon your death, what you have is a non-U.S. asset.
So what he's saying is that if you want to hold stocks in the U.S., okay, there is no gift tax. Even if you sell, there is no capital gains tax.
Correct?
But estate tax still applies.
Correct.
Now, a question is that how would you manage that? So you can have an intermediate company in either India or other jurisdiction other than the US.
Mm-hmm.
Then you will not pay the estate tax.
Correct.
The same rule apply for real property also?
So for
estate tax purposes?
For estate tax
for
purposes, if you own interest in real property in the U.S., whether it's gift taxes or estate taxes, it's a U.S.-sided asset because it's physically.
Even though you hold through intermediate company
So-
for the estate tax, I'm not talking about the
Right, so that's what you wouldn't want to do
Proper.
instead. You don't
Yeah.
want to hold your real property directly in your own name. You want an intermediary vehicle.
We'll go through a real estate slide
Okay,
at the end
fine.
that captures all the structures. Just on a clarification on the cash. So it's a weird asset. No estate tax if you have 20 million. If somebody in India 20 million account and B of A, there's no estate tax. But if a family here is going to transfer monies to their children in the U.S. from a U.S. bank account for gift tax, cash is kind of like bullion. It's looked at physical.
It's a tangible asset.
Yeah. So basically, our advice to our clients is don't transfer the cash from the parent's U.S. account to your son or daughter's U.S. account. Try to manage it outside the U.S. from the parent's foreign account to the children's foreign account
Directly.
because it's no longer a U.S. asset. And it sounds like you're trying to hide something, but no, it's just dealing with the rules and the labeling of what the cash is. And cash in a foreign bank account is not a U.S. asset. So the cash is, for example, I'm just out of college. I need a Porsche. Well, the parents shouldn't buy the Porsche and give that to the kid. That's a taxable asset. There's only $15,000. They wire the money to the kid, and he or she goes out and buys the Porsche, and then the
It's
gift of the
okay.
cash is okay. So
Oh,
Just like
this
with
is
the
very interesting. Next one, a partnership. So there is no partnership interest transfer. There is no gift tax and there is no estate tax. Huh?
Well, so it's uncertain. So when
Okay.
you're a non-resident, you own stock in a foreign corporation. Clearly, you have a non-U.S. sided asset. But what if it's not stock in a corporation, but an interest in a partnership? Now it's unclear. Is it a U.S.-sided asset or is it a non-U.S.-sided asset?
Actually, there's a different answer for estate versus gift. For gift,
For
it should be
partnership?
okay.
Yeah.
So,
Right, for partnerships and just for gift tax purposes, you should still be considered an intangible asset, and you can probably
Personal
give it
property.
away.
Yeah.
For estate tax purposes, what is it? We're not sure. If the partnership is invested in U.S. real property, for example, and it's doing business in the U.S., well, then it really looks like a U.S. asset. But if it's interested in a partnership that has nothing to do with the U.S., well, it looks more like a non-U.S. asset. And so there's really no concrete answer on what an interest in a partnership is with regard to the U.S. estate and gift taxes. And we'll get back to this when we talk about later on in how non-residents should invest in U.S. real estate. But this is one of the vehicles that we recommend, prior to tax reform, we recommended wholly to hold U.S. real estate through a partnership, because that way your interest at your death, what you hold is an interest in a foreign asset, or that's the way the argument would go. Okay. So, often the case, you don't want to hold assets through your own self. You want to hold it through a trust. And trust, then you need to determine what type of trust do you have. Is it a U.S. trust or is it a foreign trust? And it is actually very easy to be a foreign trust as regard to the U.S. In order to be a U.S. trust, you need to satisfy two different tests. One, the court test, which basically means you need to settle the trust under U.S. law. One of the 50 states settled there. And the other component is you need to have all power holders, not just the trustee, but the trust protector and anyone else who may have a substantial power over the trust. They all need to be U.S. persons. So if any one of those persons is a non-U.S. person, even though the trust is settled under the laws of the U.S., you have a foreign trust. And sometimes that's a good thing to have a foreign trust, and sometimes it's not, depending upon
So if you
your
have
facts and
majority of the
circumstances.
trustees in the US, that helps because if there's one trustee outside the US,
Mhm.
I know because foreign people may want to set up a trust in the US, and now how would you say all the powers should be in the US? So one of the trustee may have power to hold off uh, the decision.
Yep.
Depending on how the rules are written in the trust.
Right.
So that would be a little debatable issue.
That would be an issue if you're trying to be a U.S. trust. Then that would be an issue because you have one person who has a substantial power over the trust, and that person is a non-U.S. person. Then you will have a foreign trust. And again, that
even though it is set up in the U.S., it will be deemed a foreign trust.
Correct.
And sometimes there are benefits to that, like
Correct.
I mean, you know.
Sometimes it's beneficial to have a foreign trust, and sometimes it's not. And we'll kind of go through some of the examples of when that might be. So there's two distinctions we're trying to make. One is it a foreign trust or is it a U.S. trust? The other distinction is it a grantor trust or a non-grantor trust? And a grantor trust is a trust where the income of the trust is taxable to the grantor, the settlor of the trust. A non-grantor trust is a trust where the trust income is taxable to the trust itself and not to anyone else. For tax planning purposes, generally the most optimal outcome, at least for U.S. beneficiaries, is to have a foreign grantor trust as to a foreign grantor. So, for example, let's say you have an Indian patriarch. They set up a foreign trust that's going to benefit some U.S. persons. If it's set up in a way where it's a foreign grantor trust, and the trust is generating only non-U.S. income because it's only invested in Indian assets, for example, all of that income, no U.S. income, not subject to U.S. taxes, and because the trust is a grantor trust as to a foreign person, there's no U.S. taxes there either. And so when the trust does make a distribution to a U.S. beneficiary, zero U.S. taxes because it's really treated as a gift from that settlor to the U.S. person. So it's a very good outcome for the U.S. beneficiary. If instead we have a foreign non-grantor trust, we run into some pretty serious U.S. income tax issues. A distribution from a foreign non-grantor trust to a U.S. person, the U.S. person is now subject to taxes on all of the trust income generated that year to the extent that they received a distribution. And on top of it, if the U.S. beneficiary is receiving a distribution of income that has been accumulated for a few years or even 1 year, they pay a tax on top of the income tax. I call them accumulation distributions tax, also known as a throwback tax. So, if, for example, the trust was established in 2019, it's been generating income from 2019 for 10 years, so now we're in 2029. And all throughout that time, no distributions have been made to U.S. persons. But in 2029, we're now making a distribution to a U.S. person. The U.S. person now has to pay taxes on the income generated in 2029. But if the distribution is greater than the income that was incurred that was generated in 2029, now we got to go back all the way to 2019 and say, okay, there was income generated in 2019. It wasn't distributed, but we're going to pretend it was distributed. We're going to tax it as if it were distributed, and we're going to add interest on top of that tax for the past 10 years. And we do that for all the years between 2019 to 2029. So if we add up all those taxes and all that interest, the distribution that the beneficiary ultimately receives can be probably 10% of the actual distribution, because 90% is eaten up in taxes. So a distribution from a foreign non-grantor trust to a U.S. person can be very punishing.
Here's a good example we see from time to time. The foreign parents fund the Indian trust with stock, and it appreciates, and the stock is sold, and there's gain, and it's kept inside the foreign trust. And later year, there's a distribution. Well, the distribution is all ordinary income, and there's this interest charge as well. If the shares had been sold, and in that year or a short period after funds have been distributed, the U.S. person would get capital gains treatment. So this accumulations tax on income that's been from a prior year, you lose capital gain benefits, and there's this interest charge. So these are complicated issues, and trying to set up a U.S. trust instead of Indian is very hard to do because of Indian exchange controls. You're usually stuck with having to deal with foreign trusts because it's very hard to get high amounts of wealth from India into a U.S. trust where things are a little easier.
Yeah, this is very important subject, I think, for several wealth managers and others.
Question back there? Yeah.
So, oh, sorry.
I'm sorry, say again?
So what happens, when the settler dies?
Mhm.
So it is, deemed as a non-granted trust at that point in time.
Yes, correct.
So when will that, throwback rules apply at that point in time? So on the death itself, or after death. So suppose there is no distribution for next 2 years.
Yep.
So that will be accumulated from there, or it starts right from when the granted trust was started?
So it depends. So if initially it's a foreign grantor trust, and then the grantor dies, then we start counting the income from date of death forward. If it was a foreign non-grantor trust from day one, then we start counting income from day one. Okay. So how do you be a grantor trust? If it's a U.S. trust, there's a whole bunch of different ways to be a grantor trust. If it's a foreign trust, and we're trying to be a grantor trust as to the foreign grantor, settlor, there's only two ways to do it. One is the trust is revocable by the grantor, or two, the trust is irrevocable, but by its terms, it only benefits the grantor and or the grantor spouse. If it benefits anyone else or is allowed to benefit anyone else during their lifetime, then it automatically becomes a non-grantor trust from day one. Okay, so there's only two ways for a foreign trust to be a grantor trust.
So, Peter, I think this is a very important subject, so it
Mhm.
may be worthwhile taking a few moments here. See, number one, in India we have two types of trust.
Mhm.
One specific trust,
Yep.
where the beneficiaries are known and their shares are specific.
Mhm.
So trustees have no discretion to distribute the income or the capital of the trust in such proportion they like. So it's a specific to the beneficiaries.
Mhm.
So they are more or less looked at like a transparent entities in
Mhm.
India.
Mhm.
Number two, we have something called discretionary trust, which concept is known to everybody, where trustees have discretion to distribute the income and the capital in such proportion they like. So this is second type of trust.
Mhm.
Third type of trust is what is called revocable trust, somewhat like the US.
Mhm.
So when the trust is a revocable trust,
Mhm.
we call settler instead of grantor in India.
Mhm.
If somebody settles property in a revocable trust, the income and the capital is attributable to the settler.
Mhm.
So it continues to remain, for the taxation purposes, assets of the settler.
Mhm.
Okay.
Mhm.
For legal purposes, the trustees are the owner.
Mhm.
Okay. So this is a third type of revocable trust. And fourth is irrevocable trust.
Mhm.
In that case, one would look at that, whether it is a discretionary trust or it is a specific trust.
Mhm.
So if it is a revocable discretionary trust,
Mhm.
then again the income and the capital is attributable to the settler.
Mhm.
So okay.
Yes.
But if it is an irrevocable discretionary trust,
Mhm.
then the trust itself is taxed at the maximum marginal rate that is applicable to what you call individuals,
Mhm.
which is about 33%, or sometimes capital gain could be 20% or 10%, whatever it is.
Okay.
So these are the four different types of trust.
Mhm.
So when we set up a trust, it becomes very important for a settler to know that what is going to be the implication on the beneficiaries and on the settler himself.
Mhm.
It shouldn't happen that settler is also taxed and beneficiary is also taxed,
Right.
because of the systemic issues that we have between India and the US.
Yes.
Fifth situation is when, as you rightly said, you can set up a, grantor trust, and grantor, we understand, is more like a revocable
Yes.
kind of trust
Yes.
in the US.
Yes.
Okay, when you set up this grantor trust in the US, and if there is a cash or if there is another kind of asset involved, then would that be considered US cited property? And therefore, those rules will also trigger with regard to gift or otherwise.
Mhm.
So these are 4 5 situations that we
Mhm.
have to really deal with.
Mhm.
And typically, what we understand that if there is a settler in India,
Mhm.
is Indian resident, Indian citizen, and all that,
Mhm.
not non-US resident,
Mhm.
alien.
Mhm.
And if they want to transfer their assets to the children, it is better to put it in a foreign granted trust, so that when anything happens and the assets are transferred to the beneficiaries in the US, on
Mhm.
that time, at that time alone,
Right.
immediately,
Yep.
there will be no estate tax issues. Do I understand right?
Yeah.
These are a few situations. I thought I'll give you
Sure. Sure.
whatever
Sure.
you want to reflect on.
Yeah, so the idea is that so let's say we have a case where we've got the non-resident alien here in India. They've got their beneficiaries in the U.S. To the extent that possible to minimize income taxes, they would want to set up a foreign grantor trust, right? So that generally means it's going to be a trust that's revocable by them because they're trying to benefit their beneficiaries in the U.S. Often the case, though, sometimes a revocable trust is not practical from an Indian tax point of view. In that instance, the only way to achieve a foreign grantor trust then is a trust that's only benefiting themselves and or their spouse. And so in that case, then we need to have the distributions come out to them, and then they can make a gift over to the U.S. persons, and there's no income tax issues. If we're concerned about the U.S. persons, they're probably going to remain U.S. persons, and we want to shield them from estate taxes in the future upon their death, then any distributions that are going to them, we would counsel, instead of going to them, going to some trust that's established for their benefit. And because they're going to be U.S. persons indeterminately, we're going to want to have the distributions go to a U.S. trust that benefits them. And so long as the assets that are being contributed are to a U.S. trust, right, and the beneficiaries of that trust, the U.S. beneficiaries, don't actually have too much control over the assets in the trust, then all the assets in that U.S. trust will not be subject to estate taxes upon those beneficiaries' death because they will be considered as not owning those assets. The assets are in the trust, and that trust can exist for multiple generations, and for that reason we call it a dynasty trust, because it can exist not only for the benefit of the children, but it can go on for grandchildren and great-grandchildren, and exist indefinitely and never be subject to estate taxes at any level. Because it's a U.S. trust, it is a taxable entity, though, so whatever income that U.S. trust is generating, it will pay U.S. income taxes on it. And one thing about that is that if the U.S. trust is generating income, normally it will pay income taxes on the income being generated in the trust. If, however, that U.S. trust makes a distribution of that income on a current year basis to a U.S. beneficiary, then instead of the trust paying the income taxes, the individual can pay the income taxes as well. So there's a choice, right?
And the clawback will not apply because
That's
it's
correct.
on a current basis you keep on distributing the
Correct.
income.
And throwback doesn't apply to U.S. trusts. The throwback tax only applies to non-U.S. trusts. And with FEMA, it is difficult to understand to have assets being contributed to U.S. trust rather than Indian trust, rather than the Indian trust, right?
Let me throw out a simpler, because we're always grappling with FEMA and can't get Indian assets into the U.S. So my guess is there are probably a number of clients that are Indian citizenship living in Dubai, South Africa, Middle East, wherever. So once in a while we see people like that moving to the U.S. and it's going to be their permanent home. And they don't have the problem of FEMA because their wealth is outside of India. So in that case, the individual might, prior to coming into the U.S., adopt a trust, have a trustee where the family is going to be the beneficiaries. Now, in that case, made a permanent transfer into an irrevocable U.S. trust. The income's all going to flow through to the settlor because when the individual is a U.S. person, so the income is still taxable to the settlor because he or she are partly the beneficiary, but it's out of that person's estate because it's an irrevocable transfer, and that individual no longer owns those assets. So pre-arrival entry into the U.S. is maybe dump them into a U.S. trust. It's more of a non-Indian kind of approach, but we
So
see
generally you think that is it better to set up a foreign granted trust outside the US, or it may be better to do it in the US generally?
Well, you can do both essentially. You know how basically, in order to be a U.S. trust, you need to have control. All aspects are controlled by U.S. persons, and it has to be in the U.S. Jurisdiction. So what you can do is ideally you set up a trust in the U.S. according to U.S. laws, but you intentionally make it a foreign trust by naming a non-U.S. person as trustee or some other power holder. So intentionally you made a foreign trust. And why is that beneficial? Basically, if we can get it so that we have a foreign grantor trust status during the life of the grantor, right, then distributions to the U.S. beneficiary won't be subject to income taxes. So what happens then when the grantor dies? We have a non-grantor trust. Generally, a non-grantor trust benefiting U.S. persons is tax inefficient. So for that reason, we tend to counsel, well, if possible, let's domesticate the trust, make it a U.S. trust. And now because you've set up a U.S. law trust, it's very easy to be domesticating by simply changing the trustee from a non-U.S. person to a U.S. person. So now we've satisfied both control and the court test. So we have everything in the U.S. Now we have a U.S. trust benefiting U.S. persons. So we have a U.S. non-grantor trust. Then we don't have to worry about these throwback tax rules that are all listed up here.
There's something called intentionally defective trust.
Intentionally defective grantor trust.
Right, okay.
Yes. An intentionally defective grantor trust is an estate tax planning vehicle, very often used in the domestic tax planning context. So let's say I am the patriarch. I want to make a gift of $1 million to my beneficiaries. If I transfer, the $1 million of stock to a intentionally defective grantor trust, for the benefit of children, grandchildren. Now, I made a gift of the $1 million. It's below the 11.4 million, so I'm not worried about gift taxes. But the asset that's in the trust is going to be generating income going forward, right? Or that's the hope. And we want to, as much as possible, be able to transfer as much wealth as possible to the successive generations at minimal gift tax consequences, right? So if I transferred all this asset over to them, I've made a gift, but it's going to be generating income going forward. If the trust is generating income on a tax-free basis, well, that's better because I'm transferring more wealth. Because it's a grantor trust, I, as the grantor, must pay the taxes, the income taxes on the income, even though it's not my income anymore. I have clearly made a gift of the asset. It's no longer my asset. It's generating income, but I am subject to I am legally obligated to pay the taxes on the income, which I cannot benefit from. And so, why is that good from a state tax point of view? Well, I'm transferring additional wealth to successive generations by paying the taxes on that income, even though I'm not paying any gift taxes on that effective transfer. Okay.
So we're thinking we're going to run
out of time. Sure.
We should jump to the real estate.
Sorry,
Yeah.
I think, but this
come
has been
back.
very helpful.
I'll go to
Sure.
real
So
estate and
we're
then,
going
'cause
to
it's a big area.
real quickly on HUFs, HUFs.
Can't do
Yeah.
it quickly, but
Yes,
anyway.
the IRS doesn't know what an HUF is. So the best we can do is analogize it in the U.S. More likely than not, it's probably treated as a trust for U.S. tax purposes. So we just go through the analysis: is it a grantor trust? Is it a non-grantor trust? Sometimes, though, it might be a partnership, and so we have to run the tax analysis that way as a partnership.
Yeah, there's no real every case. This is the answer. It really depends. This is
Actually, just only one small
Mhm.
point.
Yes.
I think this HUF
Mhm.
gives a lot of discretion to the karta
Yes.
or the manager,
Mhm.
and therefore be more akin to what you call foreign discretionary trust
Yes.
than the partnership. Just a matter of point.
Right.
I don't want to.
So basically, if you've got a HUF where the carta is really controlling everything and benefiting themselves, and the co-partners really just kind of go along and they don't receive any benefit, more likely than not, you're going to have a grantor trust situation in that instance. If instead you've got an HUF that's benefiting co-partners more or less equally, then probably you have a non-grantor trust situation.
I mean, we had this the other day where somebody was talking to us, and they're the patriarch, and they're going to wind up the HUF, and father's going to get 99%.
Right.
And that doesn't quite align with the way it was in the past, but he's a strong personality, and the children are going along with it. I don't know what you call it, grantor trust or
More likely, yes.
An important takeaway: a lot of Indian families have real estate in the U.S. and typically buying real estate, nice house. It's hard to get financing, so we see from Asia all cash purchases, and the properties are held by the. I'm not sure this thing works on the screen here. Well, anyway, number one, they just buy the property in their own name. It's on title. Similarly, with 1, 2, and 3, it's passed through whether it's a rental property or personal residence. These people are all at risk for estate tax, only $60,000 exemption. So we get all concerned. An NRA has a U.S. real property directly in their name, from China in particular. Everybody buys in their own name. So we're looking at trying to get out of these high exposure with estate tax and see if we can get them into a corporate situation, for example, like number 7 or possibly number 6, where they're absolutely protected. A foreign person is absolutely protected from U.S. estate tax if there's a blocker, intermediate foreign company. As Peter said earlier, if somebody here owns Apple stock or IBM, that's a U.S. asset subject to estate tax. So always think of having a blocker. A major change in the tax law has simplified things in the end. The major change being in December 2017, the corporate tax rate in the U.S. went to 21%. that's a great deal. For example, if our NRA in number 1 bought a big house, fixes it up, and flips it for big gain, well, that's ordinary income tax. That's a business or development. It's not long-term capital gain. So it's ordinary income. So that person would pay 37%. Similarly, if that same fact pattern were in 2, 3, or 4, you would have ordinary income. Take a piece of land, develop it, chop it up, and sell it. It's all ordinary income. In a U.S. corporation, in 5, 6, and 7, the tax rate for corporate structures is 21%. So the opportunity for a lot of transactions, a lot of holding structures, is to take a complicated, high exposure, in some cases a higher tax rate in the top structures, and get them into a U.S. corporate form. So in my example, the developer developed the property, even if it's a number 1, prior to sale, could drop it into a corporate form, sell the property, 21%, liquidate up the company, no second level tax because it's a liquidating distribution and all the property, let's say it's one big asset or several plots, they're all sold. That's it. So you're saving a huge amount of tax. And actually in California, the corporate state tax is 8.8% compared to the individual rate that would apply on the top list at 13.3. So there's if you're seeing clients that own U.S. real estate, think of this slide, start asking, what's your structure? Because they ought to be, seriously, it's easier. There's anonymity with the structures below, 5, 6, 7. So if somebody has appreciated property now and they're a non-resident through an LLC or they hold the property directly, if they're going to sell very shortly, maybe best just drop it into a U.S. company, number 5, tax-free, and sell it. Now, a person can't take appreciated property and drop it into a foreign company. So going from number 1, 2, 3, where there's appreciated property, they can't drop it into the foreign corporate structure without triggering a tax. So it's a little more complicated if that's your fact pattern. I'll throw it over to Peter for a couple of minutes. Actually, right now, given time, you can talk about number 8, which is a final real estate structure. So the takeaway on this is corporate ownership is almost certainly the best way to go, but it still takes a little bit of analysis and thinking.
So prior to tax reform, right, number 8 was your ideal holding situation, where what that's describing basically is you got your non-resident person owning the real property at the very bottom through a rather complex, ultimately a partnership structure. And as we were discussing earlier, right, a non-resident who owns interest in a partnership, is it going to be a U.S.-sided asset or not? And there's very good argument that a interest in a foreign partnership is not a U.S.-sided asset. And so therefore you're escaping the estate taxes with this foreign partnership structure. And at the same time, because the partnership is a pass-through structure for income tax purposes, then when you do sell a property that's for investment purposes, you can realize the sale at the capital gain rate of 20%. So you're getting the 20% capital gain rate, and you're getting your no exposure to estate taxes that you would otherwise have in 1, for example.
2 questions. When a U.S. corporation is taxed at 21%, and if their dividends are distributed to an individual, what is the tax rate that individual pays on that dividend?
Well, if the individual lives in Singapore where there's no treaty, it's 30%.
Right.
Of the cash. If the person resides in India, we have a treaty, I think it's 15%.
15%.
And then you have to deal with the tax
And
here.
if the U.S. resident gets
then it's
40%?
no, 20%. It's qualified.
20%.
Right, U.S. dividends are taxed.
Right. Okay.
Right.
And if it's a foreign corporation earning income in the U.S., it's also 21% same.
Right. Yeah.
But the dividend distributed outside.
Well, you're looking at number 6 or 7.
Yeah.
So if you're looking at an operating company, I have to say that thinking is a little different than strictly real estate, but if there's an operating company, number 6, and it's merely doing through a foreign company, because that would, in the number 7, you've got a U.S. company, they pay 21%. A dividend to the foreign company would be subject to 15%. So if you say, well, hey, I'm going to beat that second level of tax, I'll go to number 6 and just have a foreign company paying 21%. To make these equivalent, there's something called a branch tax, and so it creates a second level tax, even though there's not.
Even though the distribution is outside the U.S.
Right. What they do is they look at the equity before, they look at the equity after.
Dividend
equivalent, which is what they call a branch tax. And so most people in an operating scheme, they go with number 7 because the branch tax is unpredictable. You don't know the numbers till passed. And then in this number 7, well, you know exactly. You either pay a dividend or not, and then you know you're subject to withholding tax or not. It's very cut and dry. So most structures going into the U.S., you have some foreign company and you have a U.S. operating subsidiary.
And you said dividend tax on the domestic people is 20%?
20%. There's another investment add-on tax.
3.8%.
Yeah. You could say for high-end people, it's 23.8%. There's a capital gains or qualified dividend of 20, and then there's a new tax during Obama. It's called a net investment income tax. It was something targeting the hedge fund guys that were getting.
I'm looking at 21%, and assume remaining 80% is distributed.
Yeah.
So 20% of the remaining 80%, so 16%. Mm-hmm. So it makes 37%.
Yes.
So similarly, you got if the LLP or partnership is there, which is pass through, and if they get profit from partnership, is again tax. So it equalizes in both ways. Broadly.
So what they're discussing here is in number 7 here. So when the U.S. corporation sells the property, it's paying 21%. And if what Nish is saying, if the U.S. corporation now takes that cash and dividends up to the foreign corporation, that's another 21%. So basically, you've got 21% twice here. So why are we recommending 7? The reason we're recommending 7 for real estate holdings is when the U.S. corporation sells the property, it pays 21%, and instead of dividending up, we don't have a dividend. We have the foreign corporation liquidate the U.S. corporation, and that liquidation is a sale of a security by a non-resident of the U.S. And that means it's not U.S. source income, and so therefore no U.S. taxes. So you don't have the second level of taxes because of the liquidation. Okay, so you're stuck. So you have only one level, 21% upon the U.S. corporation sale, and that's it.
And the other part that's new law back to state tax is if there's a sale with a big gain in the corporate arena, at least the company gets a deduction for the state tax. In the pass-through structure, not only is California individual tax at 13.3 versus a corporate at 8.8, so individual tax is way up, but almost all of that's non-deductible, whereas in the corporate situation, so your 8.8 goes down like 7%. So comparing 7 corporate versus 13.3, you've got a huge state tax differential. So yeah, the takeaway is really think about corporate structure if you see your clients holding real estate direct or any of those structures on the top.
That sounds very good.
Right. So, any questions?
Well, go ahead.
One important thing which we see, a lot of assets over here, when the second generation is moved to US, and they're staying there, assets which might actually run into way above $11 million kind of a limit. So it could be real estate assets, it could be financial assets. In the name of the father or anyone, and the son is already there. And typically, it will also include some mutual funds. Here we have a nomination system and all that was there. So maybe a lot of these people think in their mind that the assets are protected, they have a will or something registered. Is there any risk from a taxation perspective when it is getting transferred to the next generation there in terms of tax?
So basically, we have basically all the assets in the name of the father, right? And then the son's already in the U.S. So if first we have to deal with FEMA, right? So we can't transfer any of the assets to a U.S. trust, unfortunately, right? So we have to set up an Indian trust. So if we set up an Indian trust, necessarily after the father dies, it's going to be a non-grantor trust. So the issue there is that when the non-grantor trust is generating income, current year income distributed to the U.S. beneficiary, that's going to be subject to taxes at the current rate. But any income that is accumulated and then distributed to the U.S. person, we've got an additional taxes on top of it. So really you want to, as much as possible, make sure all current year income is distributed out to that U.S. person as it's being generated. Okay. And now if the trust is drafted properly, though, all the assets in that trust will not be subject to estate taxes should the son die while he's a U.S. resident.
See, follow, I think what he says is that if there is a US parent, for example, huge assets, simpliciter, if something happens, everything is inherited by US resident, no problem. Number one, simple proposition. Number two, that if it is kept in a trust, again, at that point of time, something happens, no problem, provided you distribute or credit the accounts of those people on a concurrent basis. Again, they will pay tax in the US, but it will remain in India. Okay, question is that if you have accumulation trust, more like a discretionary trust, when I understand accumulation is not even crediting his account, it doesn't mean that you remit the money abroad. So it's a specific trust kind of thing. Then if it's a discretionary trust like thing and you distribute the income after 10 years, then not only they tax you in the year say 2019 for that when you distribute, until such time distribution happens, they have no money to pay tax. Okay, and they do not know whether they will get it all not also, right? So you do not, the trust will not pay tax, but the moment after 10 years the beneficiary will receive, there are two consequences, and correct me if I'm wrong, the beneficiary will pay tax in the year attributable to 2019 on that year's back tax, plus there'll be additional taxes, 30% or whatever, I think, some penalty.
Ordinary rates.
Ordinary rate, whatever it is.
Yeah.
In 2029.
Yeah.
Okay. So that is how there'll be double tax. So that is why it makes it very inefficient not to distribute or credit their account on an annual basis.
Correct.
So I have a question I want to raise.
Sorry.
On large estates in India, and let's say most of the family are younger generation is in the U.S. So you've got a Indian grantor trust in the name of the parents, and the parents die, and now you have an Indian trust. Okay, some monies can get distributed to the U.S. person, but you're still locked into this 1 million.
Yeah.
I mean, which is a kind of an overriding issue for Indian purposes. You don't often even get to the issue, the opportunity of having this wealth in India. So I don't know that what's the solution really. The bigger issue
situation
is India.
that today non-resident Indians can repatriate up to $1 million, which is known to everybody, right?
Yeah.
Originally, when I was studying IMF submissions by Indian government, earlier, and we had experience of that type, if somebody was really old, he didn't have enough means, or otherwise he said there is nobody else in India, then they could make a special application to the Indian government, and he was allowed to repatriate even in excess of $1 million.
Yeah, I've heard of some exceptions or houses that are sold.
So now it is not written in the official policy, but now government has made this $1 million rule. So how they will react and what they will do, we do not know. But in the past, it's been allowed, because if there is nobody to take the property, what do? It's locked up, and therefore but it is more discretionary, and
and the rupee was 55 per dollar. Now it's
in fact, when I came to the US first time, rupee was 9 rupees to a dollar.
Oh, okay.
So travel to the US.
So we don't have a solution where there's the really large estate. We're stuck on the U.S. side with the beneficiaries, but the real challenge is FEMA.
Yeah. And other interesting thing is that assume your monies are locked up in India. You keep on earning income in India. Now, income is fully repatriable to an unlimited extent because of current account convertibility.
Mm-hmm.
So, for example, you have a house.
Mm-hmm.
You sell the house and you got $10 million. So you can't remit more than $1 million a year. But assume you do not sell the house, you rent it out, and every year, whatever rentals you get after paying the taxes, then you can repatriate entire amount to the US. By the way, it's because of current account convertibility. We don't have capital account convertibility.
Okay.
Situation.
Okay, the income can.
Yeah.
That's
Now the
current
difficulty
account.
that we will encounter. Suppose you have a house in India, you rent it out. Okay, million rupees a year, month or whatever, right? In India, there is 30% deduction on the rentals, standard deduction. So you are taxed at the rate of 33%. You are living in the US, you get $1 million rupees. I'm just getting whatever number you want to pick up, and 33% is a tax on individual in India.
Mm-hmm.
But the 33% is applied after providing for 30% standard deduction.
Mm-hmm.
So you are not allowed to deduct depreciation or other kind of so standard deduction, maintenance, and all those things is not allowed.
Okay.
So 100 rupees rental, 70%, 33% is tax. So you pay 22% tax in, say, India. I just assume, correct? Now you pay 22% tax in India. But when it comes to reporting in the US, okay, what will happen is that the exemption that you got in the US, you may have to pay 37% tax.
Right.
Okay.
Mm-hmm.
Whereas you have paid tax of 22% in India. So now you will have to pay difference of tax in the US.
Yes.
This is a situation that we need to really bear in mind. Second interesting issue, and that is where we can perhaps discuss more, is that suppose you sell a house. Okay. In India, there are some provisions under which you are allowed to reinvestment and you can get tax exemption. So if you avoid Indian tax by reinvestment, but to get, you will not get tax exemption in the US because the Indian property, you sell it, and the rollover, what you call, I believe, in the US.
Those are old days. Yeah.
Old days.
Yeah.
And now I do not know what the exact situation is. But if you reinvest in India, even though you get tax exemption in India, you will not have tax exemption there.
Correct.
So from US perspective, it may not make sense to roll over and pay up. Now in India, the tax rate is about 22%. In the US, how much is the tax on real estate sale?
If it's your personal real estate, yes, it's 20%.
20%. Right?
You get a 250, or if you're married, 500,000
Exclusion.
exemption.
Yeah.
But, after that, it's probably more like 20 plus the 3.8.
Exactly.
Call it 24%.
So these are the situations we have to deal with.
Yeah.
So whether to take that exemption in India or not is one situation. And number two, that only other thing I can possibly look at is that if you have a house in India, you may not get full deduction for interest paid on the house because of certain limitations.
Limits, yeah.
But in the US, if you have a second house or I don't know, first house also, bank interest, is it a permissible deduction or not?
Yes.
Well, the second house.
Up to a certain limit.
Yeah, 750 for first mortgage.
Nowadays it's 700. The principal balance on the loan can't be more than $750,000.
Okay. So
it used to be unlimited, then you brought it down to
when
$1 million.
you had a palace.
Now it's down to 750.
Right. So when you deal with this cross-border real estate, you have to deal with that. And one more issue, and I think the interest is so much that all our friends are here, is that there's something called probate. And can you tell something about probate?
Yeah, so probate is...
That is again a nightmare in the US sometime if you're not...
In the US, probate has nothing to do with taxes. It's if you die in the U.S. or if you die but you own property in the U.S., how does that property get transferred to your beneficiaries? If the asset is owned by you directly, it will pass through your will, or if you didn't leave a will, it'll pass according to the statutes. But in order for that to happen, it has to go through a process called probate, which basically means you have to go get the courts involved, there's a judge involved, there's a probate referee involved. It's a lot of paperwork and very time consuming, very costly. It can be probably a year or more before the beneficiary ultimately receives the assets out of probate. How do we avoid probate? We use trust. Very, very popular in the U.S. is something called a revocable living trust. It has very little to do with taxes. Sometimes it has zero to do with taxes. But because the assets are now owned by your revocable living trust instead of you, then upon your death, the assets will pass according to the terms of the trust agreement. And so you get to avoid the entire probate process. So you basically just administer the trust. It tends to take about 6 months or so just to get all the paperwork through. But you don't have to go to the courts. It doesn't have to be public because everything that goes through the courts is a public record. But if with a trust, it's completely private. You don't have to deal with the courts or anything having to do with the courts.
What is the probate duty there? Probate tax kind of duty? You have what?
The probate duty?
Yeah.
There's no taxes associated
1%
with.
or something?
Oh, it's basically when you go through probate, you have to, again, pay this probate referee. And he's the guy who's going to evaluate all the assets. And generally, the fee there is going to be about somewhere around 1% of all the total asset value. So it can get very, very expensive.
In India, we have something called stamp duty.
Mm-hmm.
Every time you
Transfer property, yeah.
Is there something similar?
There's no stamp duties in the U.S., but when you transfer real property, there may be a transfer tax on the transfer of the property. One, but it tends to be very low, $2,000, even when you talk about $1 million homes. But the other thing is that when you transfer property from one person to another, often is the case, at least in California, the real property taxes that apply. Normally, when you own real property, you have to pay property taxes every year. But those property taxes are based on the value of the property from when you acquired it, right? And if you transfer that property to someone else, more likely than not, the value of the property has increased. So the new owner is going to pay property taxes on that new value, right? And so that's a potential issue. There's some exemptions for transfers to children, but otherwise you have the increase in value, then that's an increase in property taxes that are due every year.
Another question for the point number 7.
Yes.
So if the ownership of the foreign structure changes,
Yes.
for example, I own the foreign structure.
Yes.
I move out as a director of that.
Okay.
And he comes in.
Okay.
Is there any charge?
There may be a change in the property taxes that are otherwise due because the U.S. corporation owns property, right? And if there's a change in ownership of the U.S. corporation, yeah, but there's still, that also means there's a change, a indirect change in ownership of the U.S. corporation, which means there's an indirect change in ownership of the underlying real property. Then the property taxes that are assessed on that property may change.
So the property taxes are totally unrelated to the income taxes. It's a local matter. So there are ways to help avoid that. But it's just something to be aware of. The local property taxes they don't follow the U.S. federal tax rules here. So anyway, I guess we should say thank you very much.
Very
Appreciate everybody's
discussion
time
and
great questions.
Really, thank you very much for
And,
making it. I hope this was somewhat useful.
And we'll be back probably earlier, maybe in January next year.
And of course, in the meanwhile, if you've forgotten anything, we'll be happy to give you the video.
You got the slides.
And video and slides both, so you can...
and drop us an email with any other questions that do come up with your clients.
Exactly.
And Peter and I did a presentation on much more detail. This is just one of the power slides. So we'll send you real estate, just focused on real estate transactions in the U.S. Partly the new law is really revamping the holding structure, so we're paying a little bit more attention to the real estate side of things.
In fact, other interesting thing is that sometimes to own a real estate, you can have a corporation
Mhm.
and that can own, as a business property. So if you
Oh,
have
yeah.
an ongoing
Mhm.
business there, then you can buy property in the US that is something related to the US business. You know,
Are you saying is
so
you now
for
you can
example, we
deduct
have
your
we have
air
branches in the US in Palo Alto and in
Right.
New York, right? Now people have to constantly go and stay, so we could take approval from Reserve Bank. It did not stop us at $250,000 or otherwise, but they granted us permission to put $3 million to buy a property because people have to go instead of staying in hotel and other kind of stuff.
Mhm.
So RBI has given permission, and so you can show that you are earning foreign exchange, and it increases, it helps you, and it facilitates your doing business. So when linkages are there with your business, then also you can have a property. Third way in which one could buy property is to actually carry on real estate business. And
Mhm.
suppose there is
Mhm.
Indian company and they want to do real estate business in India, in the US, then up to 4 times the company's net worth, it can invest in the US. So real estate companies can again take a benefit of that,
Mhm.
and so
Get a lot of
there
people.
are several ways in which one could have real estate, and now Indian real estate market is little bit what we call it dumps a bit,
Mhm.
and so people are looking at non-India markets because you have to geographically distribute your risk,
So I got a
and
slide that'll take care of us how to tokenize and blockchain.
yeah,
Well,
in
tokenizing real
fact,
estate around the world. This is going to
absolutely,
be the big new wave. No,
yeah,
I'm not
absolutely.
kidding. Actually, I think that's the new
I
thing
think
that's just around the corner.
absolutely.
So yeah,
So,
there's some pretty
but
innovative people.
tokens are becoming popular, particularly the new. How do you create Indian company? Or
Mhm.
there are certain issues, but in India, it is not illegal, but banks will not open your account. So it is, for example, virtual currency is not legal tender,
Mhm.
but it is not illegal.
Okay.
But what has happened is that because Reserve Bank could not control, for example, bitcoins are not called coins. They are called, actually, it doesn't fall under Coinage Act. It is
Right.
not a money. It is not foreign currency. It is not a foreign exchange. Nothing. So RBI doesn't have direct control over it, but they have control over the banks. So
Right.
they prohibited
Oh, yeah.
the banks from opening and operating accounts
Hmm.
of the cryptocurrency.
Right.
Now that circular, we are actually in Supreme Court. In next 3 weeks, hearing is going to be finally coming up.
Yeah.
If you're interested in the subject, and that's where because Reserve Bank has banned the banks to open accounts with the legitimate business players, and that is challenged in the Supreme Court now. It is
It'll over time
yeah,
work its
taper
way
off.
through because
Exactly.
it's too hard to not
Right.
not allow something that is transactional. The internet, credit cards. There's money laundering, but we still have credit cards. We're not going to
Yeah.
take those away. Just it's complicated.
But good thing about
Yeah.
the whole thing is that in this world, everything is traceable.
Yep.
Cash is just not, if you hand over back to somebody else, is gone.
Right.
So people talk about anonymity and other things, but somewhere it is always traceable.
Right.
Whereas cash, once handed over, is not traceable.
Right.
So people don't think doing something in cash is that bad, but I think e-money is something that is causing problems. So anyway, these are very interesting situations, and we are getting into the new era of digital economy.
Yeah.
And hopefully we'll have more interesting issues to discuss next time when we get together.
Yes. Our jobs are going to be more important.
Yeah.
From now.
Because those digital assets we have not yet discussed. Because today 2 hours ran off
Yeah.
without even realizing how
Next
interesting
time
the discussion was.
we'll do
Another
that.
interesting topic would be the FPI route is now open,
Yeah.
and a lot of considerable interest from outside into the areas over here.
Right.
And money is easily transferable from there to here, here to there.
Yeah.
Correct.
And US becomes an important market. So how does one deal with the taxation there as well as
Very
the overall
important. Yeah.
reporting, because if you invest in, a lot of Indians actually invest into the mutual funds. A lot of Americans
Yeah.
actually
Yeah, correct.
invest in Indian mutual funds without knowing the perfect regulations.
Well, each country is going to have to figure out their own securities rules and deal with
the
it.
perfect regulations actually make it taxable for them
Yeah.
at a security level, whereas India reports it as a long-term or a short-term capital
Yeah.
gains as you do it. So there's a lot of scope of understanding how do we go about it.
Yeah.
In fact, major problem is on characterization. India characterizes all income of the foreign portfolio investors as business income. As capital gains, where it could be a business income the other side, depending on how the situation is. But anyway, I think this was
This was
very
thanks
interesting,
a
and
lot.
thanks a lot
Thanks for
making
your
it,
endurance.
and